Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates. 10-year note yields down from the highs earlier in the week, but unchanged week over week. Not much of a change there. We did dip yields down below 220 for much of Friday and late Thursday, and I think that right now the market is kind of it's right now looking for lower yields. We're going to err on the side of caution, I guess is the best way to put it. And when you look at the possibilities of the data that we're seeing, the data really isn't helping. The data is very mixed, very weak. The inflation numbers are soft, and really there isn't a whole lot out there with equities still on the highs. Yeah, we saw some movement in the equities this week, but ultimately they're still on the highs. So I think that right now, given the potential for a pullback, whether it's because tax reform doesn't go through or whether it's because there's something else out there, the unknown factor, that Treasuries are going to remain, there's going to be high demand for Treasuries, whether it's a flight to quality bid or it's the yield. And I think that right now, as we move forward in volatility in bonds, while we've seen kind of a week which brought us a lot of confusion in Washington, we saw some terrorist activities overseas, we continue to have the overhang of North Korea, and Treasury volatility was lower. And it's surprising because we saw equity volatility rise, we saw some commodity volatility rise, and then we see Treasury volatility lower. So it doesn't mean that the markets aren't confused or concerned. What I think it means is that we're in a trend right now towards lower yields, and when the market trades in a trend and continues to do so, trades within expectations, that's when volatility goes down. And when we see it spike, it's because something out of the abnormal happens that causes the market to move. And so right now, I think that volatility is going to remain lower because yields right now are priced to go lower. And if we look at next week, we have another big event coming up. The economic data is going to be kind of blah, and I think that we've got very little on the Fed speak calendar until the end of the week, when we go out to Jackson Hole and we get to hear from all the central bankers. The Kansas City Jackson Hole Fed Symposium starts on Thursday and goes through Saturday, and that will be the key. And Friday we'll have Chair Yellen and we'll have ECB President Draghi speaking, and that will be the highlight of the conference, I believe. And we'll get to hear from Yellen in the morning and Mr. Draghi in the afternoon, and likewise that'll be a chance for them to air some of their potential changes to policy, whether it's in Janet Yellen's case the Fed's balance sheet, and whether in Mr. Draghi's case it's some of the stimulus, backing off on some of the stimulus. So recall we had some central bank meetings in Europe at the end of June with Chair Yellen in London, and that actually saw yields rally after that. Yields really bid after that, and obviously came back down very quickly, but this is the kind of meeting that can generate that kind of buzz. So right now, Treasury yields trending lower, volatility trending lower. I think that we're probably going to continue to see that until we get a catalyst move to get it to stop. It's not going to be Jackson Hole, but Jackson Hole will be a message from the central banks that they can take on to their next meetings, which aren't until the early part of September. This has been Todd Colvin coming to you from the floor of the CME Group.